So we're going to be talking about the highlights of the 2020 GIPS standards. The previous version of the GIPS standards was 2010-2011. So 10 years after that, we have consolidated a huge amount of information and come up with the 2020 edition of the GIPS standards. The GIPS standards are developed, maintained and promoted through the collaboration of many different groups. A huge number of volunteers from the investment community, well over 100 are involved with the GIPS standards. We also have GIPS standards sponsors, and that includes at least 60 not-for-profit organizations, a significant number of CFA societies around the world, but also FS societies and other associations that, again, not-for-profit organizations. We encourage organizations in a particular market to join together so that we really can maximize the network of people who are engaged with the GIPS standards around the globe. Finally, the CFA Institute, which we all know and love, really takes the heavy lifting in terms of providing the funding and people like myself to promote, maintain and develop the GIPS standards. And 2020 edition is the very latest development of those standards. Standardized requirements, which is what the GIPS standards are all about, address the calculation and the presenting of performance for prospective clients. That is what these standards are there to make sure is full, fair, consistent and comparable. What is being presented to prospective clients? These are the folks who probably don't have a conversation going on with the particular asset managers. And so therefore they need a minimum set of information from which they can compare individual managers and then ask further questions. By adopting the standards, the investment managers know that they're competing equally with each other. Again, based on a set of ethical best principles, full, fair, consistent and comparable. That's what we're wanting by putting in place these standards for the calculation and the presentation of performance. It's a minimum set of information that must be presented to prospective clients by an asset manager that's claiming compliance with the GIPS standards to ensure that they are getting full, fair, consistent and comparable information from those managers that are claiming compliance. The investors themselves, therefore, can compare the past performance from the different managers that they're interested in looking at, but then also ask for additional information. A firm that claims compliance with the GIPS standards is not limited to only presenting the information in a particular GIPS report, but it is the minimum that they must present upfront to those prospective clients. It also, a firm that's claiming compliance with GIPS is not being told how to report to their existing clients. This is all about ensuring that prospective clients receive a full, fair, consistent and comparable set of information. Now, for existing clients, some of the policies and procedures and processes that are necessary to be followed to maintain the claim of compliance will add value to the information that is being distributed to existing clients, but that is not the purpose behind these standards. These standards address a minimum set of information that must be presented to prospective clients. Now, it's not only asset managers that benefit from these standards, asset owners can also claim compliance with these standards. And that ensures that they are maintaining a certain level within the industry that they would wish the industry to also be maintaining, so that they can fully disclose and fairly present their own internal performance to their oversight body or their trustee group, but at the same time set a level for the industry to be following in terms of the information that is being presented. So asset managers or firms, as well as asset owners, are the two groups that can claim compliance with the GIPS standards. So what was the purpose? What's driving the idea that we need standards? And I'm going to refer to 3 different areas around the world which found there was a need for these standards. And if we look at the title bar, first, in the US, irresponsible and dishonest presentations bringing the profession into disrepute was one of the driving forces from the US for looking at standards. Malpractices in performance measurement and market abuse was a finding in the UK, which required investigation to see what needed to be done to remove that. And then remove from the regulator the need to address performance presentations. That was a finding in Australia, which drove towards standards. Now, typically, standards as a concept are a description of conduct or behavior that is intended to specify the appropriate course to be followed and standard of care to be observed in specified circumstances. Standards are typically designed to remove ambiguity and provide clear explanation of the expectations. They are also used to influence and control exposures to reputational risk, legal risk, or regulator recognized issues. Now, those 3 paragraphs come from a white paper that has been produced by the CFA Society UK, and then the bottom you will see the reference to that. But that is the purpose behind standards. And if you think about the GIPS standards in those lights and how that can relate to your particular market, I think you will find the relevance of a set of standards controlling performance presentation very apt. Now, in terms of risk control, there are comprehensive policies and procedures that are required by the GIPS standards for a firm to follow in order to support GIPS compliance. These make sure that there is a template for consistency, comparability, and continuity that is followed by a firm that is claiming compliance. The firm can leverage the fact that they are following these policies and procedures and help use those to internally control risk. By doing that, they're going to reduce contradictions, reduce restatements, reduce errors, and therefore they're going to enhance their reputation by controlling these risks. And particularly in a volatile market, as we're looking and living through at the moment, controlling the risks that you can control is going to be very important. Also, because there are policies and procedures, there is a transparency to the process that is being followed. And having that transparency, having those policies and procedures, having that consistency is going to help with investors' confidence. Still, investors' confidence, despite many years of talking about this, is at a relatively low ebb compared to other professions, and anything that can be done to help build investors' confidence in the financial services industry is a good thing. And part of that is about putting in place industry relevant standards. And we believe the GIPS standards for the presentation and the calculation of performance is exactly that type of tool. So very briefly, in terms of the development of the standards, this all started about 35 years ago, back in 1985, when the EC first issued its first USITS directive. But then in 1986, in America, part of that title bar that I showed you, the Financial Analysts Federation, which was a precursor to AIMR and CFA Institute, were looking for practical recommendations to address irresponsible and dishonest presentations. Similar time in the UK, studies undertaken to make sure there were no malpractices in performance measurement. Then if we carry on, we look at the president of EFAS in 1994, looking at a European solution for performance measurement standards. So in 96, EFAS concluded that they wanted to work with AIMR, the precursor to CFA Institute, to produce a common global standard that addressed performance measurement. And in 1999, the first GIPS was published, which had in its working group 15 member countries, plus EFAS and contributions from an additional 10 countries. So 25 countries plus AFAS coming together for that first version of GIPS. Then we got to the 2010 version of GIPS, where we had over 40 sponsors operating around the world, helping to support and promote and feed into that version of GIPS. And now we're looking at the 2020 version, which is split into specifics for firms, specifics for asset owners, and specifics for verifiers. And I'll get on to verifiers in a minute. In terms of the growth and where we've gone with the growth in those 35 years, we now have over 1,800 organizations in over 48 markets claiming compliance with the GIPS standards. We have 14 asset owners spread across the globe. The majority are in the US, typically state pension schemes, but we also have asset owners in Norway, Oman, Saudi Arabia, Canada, Switzerland, and Portugal, all claiming compliance with the standards. In terms of the actual spread of firms across the globe, in EMEA, we have 27 separate markets where there are firms claiming compliance with GIPS, 90 firms that are domiciled in the UK, 38 firms domiciled in Switzerland, South Africa, France. We have our first Russian Federation firm claiming compliance with GIPS this year. We have 6 firms in Saudi Arabia, Nigeria, 2 firms. We have another 18 markets with 5 or fewer firms claiming compliance, but there is growth in the EMEA region across the board. With the Americas, the vast majority are countries that are, firms that are domiciled in the US. About 1,380 firms would claim that they are domiciled in the US, but a number of firms that operate globally would choose the US as their HQ and be registered as being domiciled in the US. And then in APAC, Asia Pacific, 15 separate markets, Japan being the largest with 25 firms claiming compliance, Australia, Korea, Hong Kong, SAR, Singapore, Pakistan, India, many firms in many countries across the globe. 24 out of 25 of the largest asset managers ranked by assets under management claim compliance for a portion of the assets that they manage, claim compliance with GIPS, and 85 out of the top 100. So this is a very well established standard across the globe. So as I mentioned, in the 2020 GIPS standards, we have separated the provisions into 3 distinct chapters. We have a chapter that relates to firms, a chapter that relates to asset owners, and then a chapter that really describes what must be undertaken by a verifier. Now, firms that claim compliance with GIPS do not have to be verified, but verification is recommended as an additional level of comfort for firms or asset owners that claim compliance. Verification is the concept of an independent third party attesting that the policies and procedures that either the asset owner or the firm has in place and the way they have sorted the portfolios that they are managing is sufficient to support a claim of compliance with GIPS. So an independent third party attesting that the claim that is being made by the firm or the asset owner with regards to their ability to claim compliance with GIPS is supported by the policies and procedures that they follow. So 3 different chapters addressing different aspects of the standards and how they relate to parts of the industry. So within the standards, there are specific sections, 8 different sections, and I will refer to the chapter that relates to firms initially. Now there are general provisions and 3 sections within the general provisions: fundamentals, input data and calculation methodology, and composite and pooled fund maintenance. And I'll speak to each of those. Don't forget, what we're trying to do with the standards, what we are doing with the standards, is ensuring there is full, fair, consistent and comparable information being provided by each of the firms that is claiming compliance with the standards. Now, in order to make sure that you have consistent and comparable performance, you've got to control the input information. Typically, one would say garbage in means garbage out. Therefore, you have got to make sure there is control of the underlying fundamental information from which returns are generated. Fundamental ideas are the core principles that underlie these standards, defining the firm that is actually claiming compliance with GIPS. Any firm that wishes to claim compliance with GIPS will define the concept of what it is within the firm that is claiming compliance. Now, that concept has to be as inclusive as possible and make sense in terms of the way that firm holds itself out to the marketplace. But the actual definition of what is claiming compliance with GIPS is made by the firm itself that is going to be making the claim. So that is a core principle to make sure that is correct. Another core principle is to make sure that the reports that are supplied to prospective clients or prospective investors are indeed being supplied when they should be supplied with the information that needs to be on them. The firm has to adhere to all laws and regulations in the markets in which it operates. GIPS allows for differences in regulations within different markets by allowing the firm that claims compliance to state how what they're providing in order to be in line with the laws and regulations differs from the GIPS requirements. And you do that using a disclosure. So that's how we can end up with a global standard that is applicable where there may be different regulations in some of the marketplaces. In general, a firm that's claiming compliance with GIPS must ensure that the information presented is not false or misleading. So again, general fundamentals of the claim of compliance. Now, with respect to input data and calculation methodology, consistency of that input data is crucial. We require fair value to be used when valuing the instruments included in the portfolios that are being managed, and we require a definition of that fair value concept to be included in the policies and procedures that the firm that's claiming compliance is maintaining. In order for the input information to be comparable, there must be consistency in the approaches taken to applying those valuations. Uniformity in the method of calculation is necessary, and we have calculation methodologies as part of the standards. We allow different types of return methodology to be used according to the different types of investment portfolios being monitored. Time-weighted rates and money-weighted rates, but there must be consistency in the methodology that is being used across time. Creating a full and fair track record is key. We don't want cherry picking. That is where you end up with misrepresentation. So to get a full and fair track record, we make sure that the information that is being presented is comparable across firms and across times and is complete. So you're not just representing the oldest portfolio you have or the biggest portfolio you have, but you're representing the full measurement and management of particular style strategy, or indeed for a specific fund, the history of that pooled fund in its entirety. And we will get into the difference between composites and what they are representing and pooled fund as well, and how those are maintained across time. So those are the sort of general provisions and what they're covering: consistency, full and fair. Then there are specific types of reports that the standards address for different return methodologies, time-weighted and money-rated. For both composites, basically composites mean strategies, everything that is being managed according to the same strategy. Or for pooled funds, there are specific types of reports that are required. Now, reports include information, data returns, risk numbers, assets under management, but also disclosures. And within each of these four sections, sections 4 to 7, there are both presentation and reporting provisions, but also disclosure provisions. There are requirements, things that must be done in order for the claim of compliance to be valid, but also recommendations, which go above and beyond the requirements and indicate the best practices that can be done when presenting the information. So disclosures provide context in which to look at the data that is being provided. You've got data and you've got disclosures, which makes up the entirety of a report, whether it be a composite report or a pooled fund report. So that's really the next four sections within the standards. We also have the ability to allow firms that are claiming compliance to advertise the fact that they are claiming compliance. Advertising guidelines exist both for composites and for different styles of pooled fund, limited distribution pooled funds and broad distribution pooled funds. So that's really where we are in terms of the 8 sections of the chapter for firms. There are various glossaries and appendices also included in the chapter. So I've alluded to the idea that we're looking at a full and fair and complete representation of a manager's ability to manage the assets. And we refer to those aggregates as portfolios. Now, a portfolio from the standards perspective can be one of 3 things. It can be a segregated account, which is a portfolio that is owned by a single client. It can also be a broadly distributed pooled fund, which is a pooled fund which is regulated under a framework, a local framework for the market that permits the general public to purchase or hold shares of the pooled fund. And this concept of a broadly distributed pooled fund means that the distribution of information is not done through one-on-one presentations. Okay, now anything that is a pooled fund that could not be considered a broadly distributed pooled fund, we classify as a limited distribution pooled fund. And there are different requirements for segregated accounts, broadly distributed pooled funds, and limited distribution pooled funds included in the standards. So 3 different types of portfolios that we look at in order to generate the full track record. Now, although this slide looks rather complex, it's just a little bit of an introduction to what a composite is. Let's look at the square on the left-hand side with all the S's and F's in it. That is a collection of portfolios. That is 25 portfolios that the firm that is claiming compliance has in its definition of the entity. Now, in order to make sure that we are not just, or they are not just representing a cherry-picked portfolio from this group of 25, they need to be aggregated together so that a strategy which represents all the portfolios that are being managed identically is what is going to be presented to the prospective client. That makes sure it's a full and fair representation of the manager's ability to manage that strategy. So what would you do is you would take all those different 25 portfolios and aggregate them into composites. Okay, so if we look at the first composite on the right-hand side, that has within it 4 separately managed accounts, or 4 separately managed portfolios. Those are aggregated together as an asset-weighted combination to provide a particular strategy, and that's the light green strategy. Now, this particular firm also manages pooled funds in the same way that it manages separately managed accounts. So where you're offering a particular strategy to prospective clients, you would include your funds in with those separately managed accounts to form a composite as well. A full representation of your ability to manage the strategy. So the darker green composite has 3 separate accounts and 2 pooled funds in it. And you can carry on, as you see, through the different colors, ensuring that we've taken all those 25 and aggregated them into composites. Now, the one that sticks out is the individual black fund. There are no separately managed accounts for that particular fund. That particular fund is not offered as a strategy for separately managed accounts. It's only offered as a strategy for fund investors, prospective fund investors. So that particular strategy, that particular fund does not have to be placed into a composite. It is not being offered as a standalone strategy. It is only being offered as a fund concept. So that does not have to be artificially put into a composite. It's only offered as a particular fund for prospective fund investors. This is a change under 2020 from what used to be done in 2010. So that is why it's worth bringing it out. 5 composites are required, and the individual fund that is not being offered as a strategy does not have to be put into a composite. So that is how we take all the portfolios being managed and the entity that was defined and aggregate them so that there is a full and fair representation of the firm's ability to manage assets according to the different strategies or individual funds that the firm offers. Having done that, you must make sure, as we saw from the sections earlier, that you have the specific reports that are generated and available. There are specific reports for composites, and there are specific reports for pooled funds, and they each require different sets of information. All those specific provisions are set out in the 2020 standard. The term GIPS report would refer to both a GIPS composite report and a GIPS pooled fund report. But these are the actual reports that must be presented to the prospective clients as the initial and minimum set of information that they must receive. Now, there are various rules about the types of reports that would go to the types of prospects, depending on whether the investment that the prospect is thinking to make would be in a segregated account, a limited distribution pooled fund, or a broad distribution pooled fund. Different styles of reports would need to be produced and presented for those prospects. The firm that is claiming compliance would very easily know what are the different reports they need to be presenting and producing on a regular basis. So whilst there's an awful lot of writing on this slide, it's straightforward once you have identified the type of account and the type of prospective client that you're presenting to. And this is a matrix of those specifics. Transaction costs. Prior to 2020 edition, firms were restricted to only using actual transaction costs and making sure that those transaction costs were extracted from the returns, net and gross, that were being presented in the performance on the reports. In the 2020 GIPS standards, firms are allowed to use estimated transaction costs if and only if they cannot extract the actual transaction costs in order to generate the returns after transaction costs. Because transaction costs cannot be avoided, that is why we want to make sure that the returns that are produced and used are after transaction costs have been taken out. Typically, they are, but that's what is the requirement. If you cannot identify the actual costs, it's impossible, then you're allowed to use estimated. Typically, where you have wrap fee concepts, combined fees, you wouldn't necessarily know the exact amount of the transaction costs associated with the trading that's gone on in a portfolio. So estimates are allowed to be used, but how those estimates are generated must be included in the policies and procedures. So a little bit of widening for the application of the standards. Another thing that has been broadened out within 2020 is the use of carve-outs. Now, a carve-out would be where you have a large portfolio description. Say it would be all equities, all global equities, and you have a truly specific strategy within that definition, such as European equities. And carve-out, or the concept of carve-outs, is allowing a firm to represent those European equities as a strategy in its own right, and carve it out of all those portfolios that actually hold that subset of investments within their portfolio, and present that as a strategy in its own right. Pre-2020, you were only allowed to carve out that particular subset of investments if they had been managed with their own cash allocation. Within 2020, we now say that they can be carved out either because they have dedicated cash or because there's synthetically allocated cash. How you've come up with that synthetic allocation must be included in the policies and procedures. But this is, again, broadening the application of the standards to encourage more firms to actually adopt and take up the GIPS standards, which will inevitably raise the standard of the industry in terms of the way it presents performance information to prospective clients. So within 2020, we're trying to broaden the appeal of the standards whilst maintaining the same level of integrity that we've had before. So that's carve-outs. External valuations. External valuations with regard to real estate have been broadened out as again. Real estate investments in real estate open-ended funds must have an external valuation at least once every 12 months. Real estate investments not in a real estate open-ended fund must have an external valuation at least every 12 months or be subject to an annual financial statement audit, as it says on the slide. The real estate investments must be accounted for at fair value, and I've mentioned the concept of fair value, which runs through the whole of the standards. And in fact, within the provisions, there is wording around how fair value should be approached by firms that are claiming compliance. Private market investments other than real estate should, not must, should have a valuation at least once every 12 months. In terms of not in a real estate open-ended fund, regarding the external valuation, unless the client agreements stipulate otherwise. And if the client agreement stipulates that every 12 months is not necessary, it must be at least once every 36 months, or whatever the client agreement says, if it is in a time frame that is shorter than 36 months but longer than 12. So again, opening up some of the ideas of external valuation. Time-weighted and money-weighted returns. In a nutshell, a time-weighted return is a method of calculating period-by-period returns, so monthly returns, let's say, that reflect the change in value, but it negates the effects of external cash flows, okay? So you allow, by using a money-weighted framework, methodology, a change in the asset base, which is forced upon you by the clients, or indeed by the purchasers of units in a fund, is eliminated from the generation of the particular return. Now, a money-weighted return is a return for a period that reflects the change in value and the timing and size of the external cash flows. That is particularly relevant if the manager is actually controlling the flows in and out of the particular portfolio that is being measured. So typically, where the manager has control of flows, you would expect to see a money-weighted rate of return. Where the manager does not have control of the flows, you would expect to see a time-weighted return which eliminates the impact of the change in the asset base. There are various rules within the 2020 edition provisions which indicate that time-weighted rates of returns must be presented unless certain criteria are met, in which case money-weighted returns may be chosen. Okay, the specific criteria are listed there on the slide, 4 specific criteria: closed-end, fixed life, fixed capital commitment. Illiquid investments are a significant part of the composite all the pooled funds investment strategy. The firm, ultimately, the firm has control over the external cash flows for money weighted rates to be the essential return to be used, and one or more of those 4 characteristics. Then the firm can choose to use money weighted rates. This is an extension of what was in the 2010 standards originally. Again, to broaden the appeal of the standards and the relevance of the standards to encourage particularly more alternative managers to embrace the GIPS standards. I won't, just for time perspective, go into too much more detail around money weighted rates or time weighted rates. This slide indicates that for certain particular types of investments, the periodicity for valuations and the calculation requirements. So for instance, just to go through the top line, portfolios in composites must be valued at least monthly and at the time of any large cash flow. There is a requirement for a return calculation to be at least monthly. In addition, sub-period returns at a time of the large cash flows, then you would take those sub-returns, put them together to generate the monthly return. And in order to generate those sub-period returns, the calculation must use daily weighted cash flows. So here we have the methodology for the time-weighted returns being presented in the provisions. And then again, different for private market investments and pooled funds. Moving on, again, similarly for money weighted rates, what must be done and the frequency that it must be done. By the way, all the slides are going to be made available to you at the end of the presentation. So don't worry about the huge amount of information. You will be getting that after the event. In terms of total firm assets and how they must present it, for a firm that is claiming compliance with GIPS, the value of the total firm assets is going to be the discretionary portfolios valued at fair value, and the non-discretionary portfolios also valued at fair value. Now quickly, discretionary versus non-discretionary. Discretionary is basically, from the firm's perspective, the firm's definition, all those portfolios that they are able to manage according to their strategies. Now there may be some nuances because particularly with the segregated accounts, the clients are saying, well, yes, we like that strategy, but we don't want any technology. And the firm can say, okay, yes, we can deal with that within the policy that we're maintaining for this strategy. We can make that allowance from their perspective, the firm's perspective. They still have discretion to manage those assets in a way that represents their ability to manage their assets. However, if a client was to say, yeah, we want to employ you, but every trade that you want to do, we need to sign off. And we will turn that around in 7 days, yeah? The manager will say, that doesn't really represent what our strategy is. Timing is important. 7 days, a huge amount of things can change. So from our perspective, we don't have the ability to manage those assets according to our strategy. We are still managing them, but we're going to call those non-discretionary. Now, the total AUM that the entity that is claiming compliance will be presenting will be the value of the discretionary plus the value of the non-discretionary. And that is the total firm assets that they will be presenting that represents the size of the firm that is claiming compliance with GIPS. There are some other nuances to do with firm assets, which are again included on the slide. I won't dwell on those, again, for the sake of time. Portability. We've changed slightly within 2020 the concepts of portability, and representing track records that have basically been generated somewhere else. If a firm is acquiring another firm, and that firm that they've acquired has a track record of its own, that track record can be used by the acquiring firm if all the investment decision makers are employed by the acquiring firm, that the decision-making process that generated that track record remains substantially intact and independent, so it's still in place in the acquired firm, and most importantly, that there are records available to actually support the track record that the acquiring firm is going to be presenting. Okay? The firm may link, which is actually put that track record from the previous firm with the track record going forward, as long as there is no break in what was being generated in the acquired firm and what is being generated in the acquiring firm over time. If there's a break, the acquired track record is allowed to be presented, but separately from the ongoing track record. There must be no break in the time limit. So when a firm does acquire a second firm, the acquiring firm, if it is claiming compliance, has a 12-month grace period in which to make sure that the ongoing track record is still going to be compliant with the GIPS standards. They're going to have to take all the portfolios from the firm that they've acquired, make sure that they've put them into the correct composites or representing the individual pool funds in the correct way in order to present their information in a compliant fashion, remain in compliance, ongoing, 12-month grace period. In terms of what they do with the back history, there is no limit on the time that a firm that is acquiring another firm has to take the back history and put it into the compliant presentations. They can choose on a composite by composite basis what they do with the back history from the acquired firm in their own time. The 12-month grace period is ongoing from the time of acquisition forward. Doesn't apply to back history. That's a change. Benchmarks. When you're presenting a full and fair set of information, there needs to be a comparative, an independent benchmark that the recipients of your particular firm's information can compare your ability to manage against an independent third party. And that's a benchmark, an index, something like that. If on the composite report, the pooled fund report, the firm that is claiming compliance is presenting more than one comparative, then every comparative that they are presenting and holding up as being something that they are presenting their track record against must have all the information relevant to a benchmark for each of those benchmarks. You can't say, oh, this is the primary benchmark and all the others are secondary. All the information that is required must be presented for each benchmark that is being included as the comparative in the GIPS report. That's a subtle change from what was in 2010. As I said earlier on, there is data in a GIPS report, and there is also disclosure. Disclosure generates the context, the understanding of how that data has been generated. And not surprisingly, as we've moved into the 2020 version, there are new or revised required disclosures. I have 4 pages of those. And again, time-wise, I'm not going to deal with all of the nuances of those. But there are changes in the claim of compliance because as we've moved into 2020, there are subtle nuances around that. New disclosures around GIPS trademark. Risk has a more prominent place within the 2020 standards than they did within 2010. There are new disclosures around risk and revised disclosures as well. Because don't forget, risk and return at what cost are the three components that are key for prospective clients to understand. Yes, I generated this return, but at what risk did I adopt in order to generate the return, and what would be the cost to you as a client for engaging in this particular strategy? Those three types of information, three pieces of information, are key. New disclosures around real estate. We've talked about external valuations. There's subtle changes in what needs to be disclosed around leverage, derivatives, and short positions. New disclosures around time-weighted rates and money-weighted rates, because we've expanded the use of the money-weighted rates. Not surprisingly, estimated transaction costs we've talked about. Again, fees, I've already related to fees. If model investment returns are being used, then again, how have those fees been generated? So what is the model that is being followed? So new disclosures around fees. Depending what you're presenting and to which type of prospective client, there are specific requirements around the fee schedule that must accompany the GIPS report. Those requirements are consolidated in this slide. When presenting a particular type of report to a particular type of prospective client, what must the fee schedule be? So take some time and have a look at that later on. Theoretical performance. A lot of houses will have modeled or generated ideas using theoretical performance. GIPS Standards is all about presenting actual performance, what the firm actually managed to do in reality with real money. If theoretical performance is presented, it must be presented only as supplemental information. It is separate from the actual information itself. And there are various disclosures that must accompany the presentation of theoretical information. Those are detailed there. Provisions are great. They put everything in context, but after a while you get so many provisions, so many disclosures that the value, the real information that needs to be understood by the prospect is lost through too many disclosures. So we have included sunset provisions within 2020, which enable firms to include disclosures for a limited amount of time and then take them away after that time has expired. Typically 12 months is the minimum amount of time certain disclosures must be included. I mentioned briefly that there's also the ability to advertise the fact that a firm is claiming compliance. And there is within the Section 8, the advertising guidelines, there's a number of provisions relating to what type of information can be included in something that is considered a GIPS advertisement. Now, just because a firm chooses to follow GIPS advertisements does not mean they do not have to follow all the provisions regarding GIPS compliance. They do have to make sure they're following all the provisions that relate to GIPS compliance. Advertising is an option that a firm can consider to follow, and there are various options within the advertising guidelines that a firm can follow, and those are documented there. I mentioned briefly about verification. It's the concept whereby an independent third party will attest that the firm that is claiming compliance basically has in place the policies and procedures that would support such a claim, and that they are indeed generating the correct track records for the strategies or the individual funds that they will be presenting to the prospective clients. The third chapter that I showed you at the beginning that relates to verification explains to a verifier what they must be doing in order to provide a quality of an actual verification report that is valid. It is a very strict level of work that must be undertaken by the firm that is carrying out the verification And this is a way of ensuring that the quality that is being provided by verifiers, again, is consistent and comparable around the world, regardless. Again, information is available in this deck on that. Asset owners as well as asset managers can claim compliance with GIPS. An asset owner is typically defined as an entity that manages investments directly or using external managers, but on behalf of the participants, the beneficiaries, or the organization itself, sovereign wealth fund, a pension plan, something like that. The asset owner concept applies to an organization, not to an individual. Okay, so it applies to an organization. These are going to be groups. Asset owners are typically accountable to an oversight body, trustees, and they want to make sure that they are following the industry's best practices when reporting the information internally. Not only that, but as asset owners, by supporting these ethical best practices, they can raise the standard within the industry. It also means that any information that they are getting from external managers, they can say to them, we run all our information following the GIPS standards internally. We would like you to report to us following the same standards, so there is consistency, comparability, the information we're receiving is full and fair. It makes their role as aggregators of information about the assets that they own much more straightforward. And also, it raises the integrity of the industry in general in the way it is calculating and measuring performance. So, specific chapter that relates to asset owners, because they are not presenting information in order to gain outside participants to join them. They are reporting internally. So some of the requirements about how they must present to prospective clients have no relevance to the asset owner. So we have some few slides for that. So 2020, the effective date. These were published and became effective 1/1/2020. However, because of the rules within the GIPS standards about the frequency of reporting and when reporting must occur, the first reports that will be generated that must include information, data that has been gathered following the 2020 requirements will be those reports that come out in 2021. So GIPS reports with periods ending on or after 31st of December 2020 must be prepared in accordance with the 2020 edition. So at the moment, firms will be making sure that the information that will be necessary and gathered in order for their reports that they are publishing in 2021 to be in compliance with the 2020 GIPS standards is currently being collected within their operation. Firms can choose to early adopt the standards, but they must comply with all the requirements. This is not a pick and choose what you wish to comply with early or not. You are either complying with all of it, or you must comply at least by the time you get to reporting in 2021. So that's really where we are with the effective date. So from the perspective specifically of Ukraine, where there are yet to be firms claiming compliance, when's the right time to be considering the GIPS standards? When should you be thinking about these and possibly thinking about their relevance and their value when you're implementing? Obviously, when you're setting up and you're trying to work out what your input information should be, what calculations you should be doing, how you should generate returns, what a track record should be, what you should be presenting to prospective clients, go to the GIPS standards. It's there. It's an off-the-shelf solution for all of those issues, and will provide you with the policies and procedures that can be used throughout the organization: business recovery, business continuity, key person dependency, internal audit, All of those things can really benefit from a decent set of policies and procedures. Knowing where they are, pulling them up when you need them. When you're setting up, go with those set of globally recognized standards. If you have to change, when you're changing systems, changing valuation software, think about, okay, is this a chance, is this the opportunity where we can also engage with the GIPS standards? We have to make this change. Why don't we make sure that we raise the standard as we're making that change? If you can't justify your proprietary approach, if prospective clients are asking about the GIPS standards or want to see that there is a standard that is being followed, they can't work out what you're doing, and you're spending an awful lot of time justifying your proprietary approach. Why not just go with a standard approach that is available, that prospective clients can actually read for themselves, get the chapter. If you can't continue to justify, think about that. When an individual firm or firms in general in a specific market are in difficulty, information has not been as transparent, information has been confusing, inconsistent, contradictory, then is probably the time to think about standardizing. Don't forget the reasons why standards are there, what their purpose is, why they're there. When you're in difficulty, one way to get out of that is to go and adopt a set of standards, independent third-party standards. If you want to raise the hurdle, either as an industry or as an individual firm, you can be seen to be following best practice within the industry. You can actually be seen to be a leader, being the first, driving change to ensure that the industry is beholden by the prospective investors as following best practices. You're helping to build better reputation for the industry as a place to investors to be confident that best practices are being followed. If you actually need to raise the hurdle, something's gone wrong, your reputation's absolutely shot to pieces, nobody trusts the information because something that's happened. Okay, it happens. Counteract the poor perception, reduce these reputational risks, be seen to be following these independent third-party standards. It is a move back towards a better reputation. So there's a number of different ways and places to consider implementing the GIPS standards and what it brings to both an individual firm but also to the industry. So with that, here are some resources that you can look at yourself, as well as the slides which will be distributed. The edition of the GIPS standards is available on our website. You can download it as PDFs. There are various webinars that can also be followed. You obviously have your own set of webinars that are being collated by the CFA Society. We have a help desk where anyone can submit questions, and they are answered by a team of experts in a very short time frame, somewhere between 3 and 5 business days. And that's open to anybody, firms that are thinking about compliance, more questions about the standards. Interpretations of the 3 chapters which I showed you are being created at the moment. Those will be issued for firms by the middle of this year, and for asset owners somewhere towards Q3 of this year. And those really put into context each of the provisions and how to apply those provisions in broader context. The chapters that I have shown you are specifically the provisions in the 8 sections that are being written. Finally, I am a resource for all of you. My email address is there included at the bottom. Any questions, don't hesitate to reach out to me or reach out to Anna and others within the CFA Society Ukraine, and those questions will find their way back to me. So with that, thank you very much, and I pass back to Anna to see if there are any questions that I can answer at the moment.
But the first question is, who do you think in the firm is responsible for its compliance with GIPS?
Typically, in my career as a performance measurement generator, the impetus, the move to adopt standards came from the performance analysis unit. They wanted there to be consistency, comparability, no questions from the managers as to how is this being done, or the managers asking for different ways for information to be generated, because every time you generated a set of presentations, there were a whole different set of assumptions being used each time, and you could never tie back the next presentation to the previous one. So the desire to have some form of standardization really came from those responsible for generating the performance within the organization. But the claim of compliance is something that belongs to the firm. It is the firm saying that it is following these standards of practice, best practices, ethical best practices, and they're running their business following those standards. So it cascades through the whole firm, and really, the people that drive the way a firm holds itself out to the world is the C-suite. They're also in control of the budget. So getting the input and the support from the C-suite will ensure that you leverage the claim of compliance across the firm. It is not just about how you present performance. It's about the input data, the calculation methodology, what you show people, so how the sales force and the marketing force represents the firm's ability to manage and what they're managing. So GIPS permeates the whole firm. So support from the C-suite is key. It is going to take some change in a firm that already does these things but doesn't follow a standard. I would maintain that it is asking a firm to do the same sort of things they've done, but just in a different way, and putting policies and procedures behind that, and therefore controlling risks, reducing risks, and also raising the standard at which the firm operates. C-suite will be responsible for supporting it. Probably the performance analyst that is responsible for the generation of performance will be the person who is concentrating on the standards and making sure they're interpreting them correctly for each of the firms. Ultimately, your legal department and your compliance department, because you're claiming compliance with something, would also wish to be involved. So you'll have a committee which will consider GIPS compliance. Somebody will be responsible for the actual implementation, the performance specialist. The C-suite will be supporting it and ensuring all the benefits of claiming compliance are being known about through the firm. And the compliance and legal people will be the ones ultimately who will be on the hook for the fact that you're claiming compliance with a particular standard. So it's an aggregate of people across a firm. We have a document which is called Implementation Assistance to Firms Considering Compliance with GIPS, which is again on the GIPS website, which talks to some of this as well and indicates for firms thinking about GIPS some of the things that they should be considering as they go through that journey.
We have another one question. If you are showing carve-out separately, do you have not to include the carved-out instruments in the performance of other portfolios?
So if I understand correctly, every portfolio that includes that carve-out subsection has to be taken and aggregated into the carve-out composite. So all the portfolios that have that European equities strategy as part of their bigger investment strategy, you need to take that carve out from each of those portfolios. Now, I don't mean you literally take it out, but you would take the performance of that European equities carve out and put them all into a composite. And you present the composite of those carve outs. So again, full and fair. You take it from every place it exists and aggregate them together to produce the carve-out strategy. If, by the way, you end up landing a mandate that is purely European equities, based on the fact that you presented this prospect, that carve-out, you then would present that actual European equity mandate separately from the carve-out and as well as the carve-out composite. So recipients would be able to see, okay, this is what the carve-out indicated they were able to do, and here's the actuality of what their equity-only portfolio does. So you would show it in those ways, okay? Again, all within the standards, but it's a composite of carve-outs from all those portfolios that contain that carve-out.
So thank you so much, Ian. Thank you so much
Pleasure.
for the presentation, and thank you so much to everyone who joined us today. See you next week on our next webinar on our professional development. Thank you.
Thank you.